Saurabh Mukherjea joins us. Let's say hello and good morning to him. Saurabh, good morning. Thank you for joining us. You know, it's turning out to be one of the best summer rallies I've seen. 2023 summer will be remembered as a patch where the bulls completely dominated the markets.
And I think it should be, right? I can't remember any other juncture of my career, right, where, say, interest rates have gone up by the best part of 3% in India, and you still have 7.2% GDP growth. I can't remember any other decade, any other juncture in American history where rates are up by 5% in America in, say, 14 months, and yet America is at full employment. So these are exceptional circumstances. In a way, courtesy the war in Ukraine, we had a spurt in inflation the world over. Central banks moved to hike rates aggressively, but such is the strength of the Indian and the American economy. Such is the strength of these two large economies that, in spite of very punchy rate hikes, the macro is holding up really well, and that bodes well as inflation comes off, as the inflation print moves towards, say, the 3% number. Hopefully, rates will ease off in the next year and a half, and I think that bodes really well for economic growth and for the stock markets, both in our country and in the United States.
Where are you in terms of understanding the true value of this market? Do you think we are now not in the value zone, we are fairly priced, or are we richly priced?
Look, I mean, I would say that for the sort of investing we do, Nikunj, for the sort of quality companies we buy, YOY we are only up. YOY we're only up 5-6%. Although this fiscal we are up 11-12% in most of our portfolios. YOY we're up 5-6%, and if I take the last 2 years, our investee companies would have grown earnings by around 45% or so. So 20% compounding each year, total growth in earnings around 45%. And in the last 2 years, our investee company share prices are up, say, 10-11%. So I think there's still a big catch up. Earnings growth for the sorts of companies you're flashing on the screen, earnings growth for these companies has been very strong for the most part over the last couple of years. And yet the share price performance has lagged. And I think that piece unwinds as we go into a more normal economic recovery with inflation coming off. I think we will see the share price action catch up with earnings growth. I think you're just referencing HDFC Bank. If I take the 4-year CAGR on HDFC Bank's earnings, it'd be around 21-22%, but the share price action has only been 5%. So big catch up there. Quick disclaimer, I'm invested in all of these names, so are my parents, and so are our 9,000 clients. But I think we're a long way away from being fully priced. Lots of upside action left. Part of it will be FIIs, but I also think domestic flows will pick up as we approach the election of the year hence.
In the overall scheme of things in which you invest, how much importance would you give to 2024 general election cycle? Because that could be a re-rating or a de-rating event, at least depending on the outcome.
I think, look, I mean, in any other country, my answer would be the general election cycle will be a critical driver of FII flows. The general election cycle will be a important driver of stock price movement. Where I think India is slightly different is because of our assembly elections and the frequency with which we have assembly elections, and the assembly election results are all over the place, right? Some go in favor of the ruling dispensation in Delhi, some of the assembly election results go against them. I think that gives you and me a significant hedge against a big event risk around May 24. So May 24 will be important, but given that there's a whole bunch of assembly elections between now and May 24, I think that risk gets spread out over time, and I don't think that's any bad thing. That being said, almost and I have to admit, half the FII conversations we have, half the foreign investors that we're trying to bring to the country do reference the May 24 elections, and it could well be that the May 24 elections do end up being a trigger around which FII action does hinge.
Hi, Saurabh. This is Anisha also joining in the conversation. I was just reading one of your latest newsletter, which was talking about how one can make money and ride the luxury wave across the globe as well. You're not following the same theme back home?
So, we have Titan in our portfolios, and companies done extremely well for us. Not just jewelry and watches now, but also online jewelry. Taneira, which we think is on the cusp of profitability. Their spectacles business, their eyewear business is the largest in the country, again has become profitable. So it's an unusual, high quality luxury play in India. We don't have so many of them. We have Nykaa in the online space. We've been looking at Nykaa for a while, but haven't been able to build up the conviction as yet. And that's where we highlighted Hermes to our global clients too. So we run a PMS based out of Gift City for Indians to invest in global plays, and we said that companies like Hermes are an unusually long dated play on global consumption. So just the numbers are quite unusual. The number of dollar millionaires are growing at 7% per annum. It's a staggering figure. The number of dollar millionaires globally are growing at 7% per annum. And therefore, luxury plays like Hermes, which sell handbags of 20 lakhs, 30 lakhs, those sorts of companies give you a play on the structural uptrend in global prosperity. Titan is the local play, Hermes is the global play in global compounders. And what we are submitting to your viewers is building a portfolio which is half Indian and half American allows you to benefit from this uptrend in prosperity in the world's two mightiest democracies.
Sure, just scratch that point further. You mentioned about Nykaa and the fact that you're looking at it. What's holding you back? Are you looking at making investments there? Is there any red flag that you have come across?
Well, I think the main thing, as we have done with all our investments, we look for dominant franchises which are able to show that they utterly dominate a specific area, are able to command the price premium. The dominance could be around brand, it could be around technology, it could be around network effects. In Nykaa's case, we're not yet convinced that the dominance is quite yet there in the beauty and personal care space. And we're a little bit concerned about the investments they're making in the apparel space. In the apparel space, Myntra clearly has done a good job, and we're not fully convinced that Nykaa investing money and hard dollars in the apparel space is a great idea, given that their dominance in BPC doesn't seem overwhelming. It's clearly an enormous credit to Falguni Nair and the team there. They've built a powerhouse business out of scratch. But I think we'd be a little bit more comforted if we could see more evidence that their tech drives overwhelming dominance of the BPC space.
Right. Saurabh, morning. Just wanted to get in your take on this big tech revolution in the form of AI being a huge disruptor, as to what it would mean for individual companies. Is there also, to a certain extent for tech companies, that fear of, replacing jobs or roles?
So look, we're not experts on generative AI, but from what we are hearing from the two big sectors where the impact, I think, will come the earliest. First off, financial services, right? It's clear that lenders in our country, the sorts of lenders we have investments in, HDFC Bank, Kotak Bank, Axis Bank, Bajaj Finance, it's relatively clear that these lenders will use generative AI in their credit assessment processes, perhaps even for customer servicing. So in the case of lenders, my reckoning is AI will help them do more with less expenditure on headcount. It'll allow them to provide better services, better credit underwriting at lower expenditure. And I think therefore for lenders in our country, it's a positive. On IT services, there's a raging debate. Some people say that Indian IT services will be adversely affected. Our view is slightly more positive. We think elements of IT services, testing of software, for instance, will get increasingly automated. AI will play a role there. And secondly, as the Fortune 500 companies, all of them make a rush towards AI and generative AI. I think the impetus to move towards cloud, the impetus for all of these companies to move towards cloud becomes even greater. As I think Accenture has said, only 30% of the world's large companies have done their cloud migration. 70% are yet to do so. Our reading is AI hastens the trend towards cloud, and that can only mean one thing for Indian IT services, which is more work, more business, which is why we are a little skeptical of this current bout of gloom and doom about Indian IT. We reckon Indian IT remains a great space to invest in.
That's a great point, that what's happened to NVIDIA and what's happening to the AI world, that's completely different. What's happened, Indian companies, what they offer, that's a completely different platform and a back-end service. We are trying to compare apple and oranges here. They both are completely different kettle of fish. But my limited point and a follow-up to your point is that Indian IT companies are dependent on the BFSI space, the banks, the insurance companies to generate revenue. That is where there seems to be an imminent slowdown. So if the US economy slows down more, and if some of the banks and other insurance companies and manufacturing companies, they start reducing their outsourcing activity, don't you think that for next 2 or 3 years, the sector per se could go through low growth?
So, Nikunj, let me just take two points. Let me take the structural point, right? The structural point, you nailed it very nicely there. NVIDIA is the hardware, the chips behind AI. We are investing in that in our global portfolio. TCS is the kind of the foot soldiers, the OPEX. TCS is the OPEX that will deliver AI to the world's largest companies. We're investing in that in our Indian portfolio in consistent compounders. And that's why, again, I stress again, right? An Indo-American portfolio or double engine portfolio where you play a trend like AI through hardware in the global portfolio and the software piece you play through the local portfolio. So that's the structural theme. Now let's focus on the here and the now. Yes, America is going through a slowdown. It is relatively clear that IT services companies in America will have throttled off, not will, they have throttled off their near-term IT service spend. But I've never understood how anybody can make money by looking at short-term trends. In any DCA valuation of large companies like Infosys or TCS, the 1 year, 2 year numbers are irrelevant. What drives valuations is the next 5 years, 10 years, 15 years, 20 years. And on that count, AI only increases the amount of work Indian IT services will get. AI increases the need for cloud, and therefore I think AI increases the need for Indian IT services companies. It's a bull trend, it's not a bear trend. We overlook the short-term noise, focus on the long-term signal.
Okay. I have the public holding of your three big portfolios: Rising Giant, Little Champs, and Consistent Compounder. Any marquee changes you've done in any of your portfolios in last 6 weeks?
So in the Little Champs portfolio, over the last couple of months, Nikunj, we've bought Metropolis. So in Consistent Compounders and in Rising Giants, we have Dr. Lal Path Labs. It remains an investment that we feel very bullish about. We doubled our investments around 12, 13 months ago in Dr. Lal Path Labs. But looking at how Metropolis has emerged from COVID and looking at their dominance in the city in which I live in Mumbai and Maharashtra generally, looking at how Ameera Shah has steered this business through COVID and how she strengthened the franchise coming out of COVID, we felt that Metropolis deserves a place in the Little Champs portfolio. So that's been the main addition in the last couple of months. I think much like Dr. Lal, Metropolis's valuations have actually fallen even more in the aftermath of COVID, and we felt that combination of a great franchise in the Mumbai and Maharashtra region combined with strong cash flows, impeccable balance sheet made Metropolis a very tasty investment.
Metropolis, you own Dr. Path Labs. You're really bullish on diagnostics.
Dr. Lal Path Labs, we own in the CCP and in Rising Giants, in the large and mid-cap portfolios. Metropolis, we own in the small-cap portfolio. Yes, we're bullish on diagnostics. It's an essential product. It's an industry where there is rapid consolidation. The venture capital funded forays are falling by the wayside. The handful of cash generative, well-managed franchises are going to consolidate the market. It's a $10 billion market. Nikunj, only $2.5 billion is in the hands of the organized sector. $7.5 billion is in the hands of mom and pop path labs. And I think the consolidation will take place over the next decade or so. And we want to be there and make money from it.
Okay, thanks very much, Saurabh, for joining in and sharing with us your outlook on the markets and those individual sectors as well as the portfolio allocation.